Understanding trend patterns and how to read, understanding how to read a chart and then identifying trend patterns on a chart can help you make very successful trading decisions. Now, technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of a share or a security reflects all the information about it that can share, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in share prices. For example, a head and shoulders pattern, channels, triangles, and wedges. These are formations that we can see on the charts based on price movement. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occurs between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of the asset as the price breaks psychological barriers in the form of support and resistance lines. So basically, chart patterns are just patterns that appear in price movement on charts. There are numerous types of patterns, all named according to the shape that the price graph forms between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. When these patterns develop, it's telling the trader that there should be a specific market reaction. Whether it's a market reaction up or down, we don't know, but it tells us one is about to happen. And then when it does react, it tells us what we can then expect of that pattern. So the most common chart pattern that traders look for are called triangles. Triangles come in symmetrical triangles, ascending triangles, and descending triangles. Now that sounds like a lot, but it's really in the direction the triangle is going. As you see here on the left, a symmetrical triangle, the upper and the lower channels are an equal proportion or equal angles. In an ascending triangle, the support line is horizontal and the trend line is on an angle coming up to it. In the opposite, in a descending triangle, the support line or the resistance line, depending on which price is moving, is horizontal, and the trend angle then, or the price channel angle, then descends on it. But in all three cases, what is important is, number one, is to recognize the pattern, and we can all see triangles pretty easy, and recognize the action. Because what's happening, what this is telling you is the price is being forced into this ultimate channel here, this ultimate tight squeeze, and is going to have to react when it gets to this point in a certain fashion. And it's either going to break down or it's going to break up. So it is the congestion of price movement in the pattern. So a triangle is formed between converging support and resistance lines. A negative slope resistance line indicates a reducing level of profit taking or more uncertainty about the value of a security. With a positive sloping support line, the price levels are squeezed into a corner. Once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released, and a certain amount of momentum is added to the price change in the direction of the breakout. So if it breaks out this way, and what we can expect is when it makes the breakout, for a short period of time, it's going to have some momentum behind it. So this would tell us when we recognize this pattern, we should be trading this asset going up. And in a short term, not for a long-term investment. So for binary options, it works very well to trade it in the next time frame, the next expiry, or when it breaks down, you would trade it to go down, because what it's telling you is okay, the markets have now broken out. It's not telling you that the market's not going to come like this, go like that, and go like that. But at the moment, it has momentum. And because it is this pent-up momentum that either the bears or the bulls have now gathered the strength to break out, for that next short little while, it's going to have some momentum. So a breakout is one of the key things that traders look for and to make profit. Okay. And it's the momentum that is added to the price change in the direction of the breakout. Now, there are specific variations of triangles that can occur, namely ascending and descending. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. It's these two right here. Okay. So basically, remember, when price is moving up, okay, this would be your resistance line, and this would be your support line. When price is moving down, okay, this is your resistance line. So as you notice, in a downtrend, to form the triangle you have there, in an uptrend, you have the horizontal line here to support the channel or the development of the triangle. Now, an ascending triangle usually occurs as a continuation of a bullish trend, while a descending triangle usually occurs as a continuation of a bearish trend. You can see that in the price charts on the right-hand side. So here we have an uptrend, a slight uptrend, support underneath the uptrend line, horizontal support line. Descending triangle, price moving down, support line. Okay, ascending triangle, we have both them moving in together. So basically an ascending triangle has an angular support line and an angular trend line. I'm sorry, I'm having a little problem with my marker tonight, but we'll get it off here. Nope, it doesn't want to turn off. There we go. Okay, using triangles to trade, it is important to note that an ascending triangle can also be found in a downtrend. So the combination of the name of the triangle and the market trend is deceiving. Thus, the financial asset needs to test the resistance line twice and needs to test the resistance level twice, and the asset closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. So in other words, when you have the trend line, okay, to actually be a triangle, because you see these shapes forming, but they don't fit the rules. And if you don't follow the rules, then you're just blindly trading some type of a format. So let's go through this again. Okay, in an ascending triangle, okay, the trend is deceiving. The financial asset needs to test the resistance line. When price bounce up to this resistance line, bounce off of it at least twice. Okay. And the closing price needs to be higher than the previous close. So not only does it need to bounce up and test the resistance line, it needs to close higher in the next time frame than it did in the previous time frame. In other words, the closing price has to follow the rising trend. So you need twice to test the resistance line, and that the actual center of the triangle, when you're forced in here, will fit those rules, that the close has to be higher than the previous close. So once you have it testing this resistance line twice, and then the close is the higher than the previous close, you now have the final formation of your actual triangle. Okay. Now when we come to volume, when in ascending triangle, volume usually contracts. Although there are a few numbers and cases that show volume has not contracted. Volume is the number of shares or contracts being traded in a specific time. There's a relationship between the trend and volume. When the trend is moving in a specific direction and volume stays steady, it's supporting the trend. If volume increases while the trend is happening, means more and more traders are jumping into the market and supporting that trend. Okay. When volume contracts, it's telling you that the traders are getting indecisive. And when you're getting into the wedge of a triangle, the center of a triangle, you should be getting this drop in volume because the traders aren't sure where this is going to be, where it's going to be. So now you have 3 pieces of information to determine your triangle. So the distance between the rising trend line and the resistance level give us our projection, because this is going to give us a projection of where we can expect price to move. So at this point, if we get the breakout, okay, this breakout should be equal in the distance of the third side of the triangle. So if our resistance level had a level of 1 and our trend line had a level of 0.5, then our projected value would be 1.5. So we're expecting a 1.5 or an equal distance to what the width of this triangle was in an upward movement if it's a breakout up. Because from an ascending triangle, we are looking for it to regain its traction on the trend line. You're not looking to trade going down because you're not looking to trade against the trend. Now, besides triangles, you can also get the formation of what's called channels and rectangles. A rectangle is exactly what it sees. It's a channel develops when your support line is running horizontal and you have range trading, so your trend line is also running on a horizontal. A channel is formed between parallel support and resistance lines. This pattern can indicate This pattern usually indicates a relatively strong trend up or down, with the price staying within the lines until a breakout. A breakout from a channel indicates either a reversal in the trend or a change in the slope of the current trend. So you can get a breakout going up. Okay, and when you get that breakout, this one is a reversal of the trend, because as you see, price is moving in a downtrend. Now, these tops and bottoms are the peaks and valleys of price movement, and the support and resistance line are gathered by finding price points in common. And when you have this breakout, it's most likely telling you that there's a reversal happening. Channel's the same, rectangle's the same, except it is on two horizontal lines. Okay. Now we have up channels and down channels, similar to a channel. Okay, and then we have rectangle. Rectangle is a pattern formed between horizontal support and resistance lines, similar to a channel. Rectangles and channels are sometimes referred to as flags and pennants. Okay. Depending on the slope of the initial trend and the slope of the breakout. A flag would be defined as a bullish continuation channel down. There's a lot of mouthful there. A bullish continuation channel down, or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. Only called a pennant because they look the same. They're forming a pennant like you wave at a sports game. Then we go into wedges. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. However, where the support and resistance line in a triangle have one positive and one negative slope, the support and resistance line of wedge would both have a positive and a negative slope. Wedges with positive slopes are called rising wedges, and ones with negative slopes are called falling wedges. Okay, now all of this gets to be a lot to remember, but the fact is they're all, except for rectangles and for slopes, rectangles and channels, all of the ones that kind of form triangles. Okay, breakouts are breakouts. So whether it's a wedge or it's actually ascending or descending triangle, they do have slightly different variations. They have slightly different rules, about them. But visually, they all kind of look the same. And anytime you see price congesting into one of these patterns, it's telling you something. And a wedge and a triangle tell you basically the same thing. The most common wedges are found as breakouts in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. So here we have a falling wedge, so we're looking for a bullish breakout. Here we have a rising wedge, and we're looking for bearish. When we get the breakout, if you notice, okay, we have price moving in towards a downtrend. We form the wedge, and we have the breakout of the wedge, and then price moves into an uptrend. Here we have an uptrend. Price breaks out to the bottom, and it begins the beginnings of a downtrend.